media. Let's get some reaction now to Perry's criticism of Bernanke and the Fed. David Stockman is the former director of the Office of Management and Budget under President Reagan and a former executive for Wall Street and private equity firms. Also still with us, of course, is Mike Aronstein of Marketfield Asset Management. David, I want to kick it off with you. So Rick Perry being very harsh about the Fed. Your thoughts in terms of what he had to say?
Well, wrong choice of words. He should have said stupid, destructive, another windfall to Wall Street that's left the middle class high and dry, that's going to slam savers for another 2.5 years.
You're very critical of the Fed's zero interest rate policy.
It is terrible.
And telegraphing that it's going to be that way for several years here.
This will make 4.5 years, 2.5 already done, 2 more to go of zero interest overnight money. It's a screaming invitation to speculation and to every kind of carry trade known to man. It tells Wall Street, load up the truck, short, borrowing money overnight, buy the 10-year, we got your back. In fact, we're going to actually do Operation Twist and appreciate the 10-year. So just lay back, have a nice sleep, and print money for the next 2.5 years. This is outrageous. This is a scam, and I don't agree with the word Perry used, but Wall Street needs to be stopped, and Bernanke needs to be stopped, because this has gone over the top.
David, what do you think the Fed and Bernanke should be doing? Because when you look over at the ECB and see them tightening into a recession, it also must make you, ponder what's going on over there.
Not really. This has nothing to do with interest rates. This economy is drowning in debt that we created over 30 years. We don't need low interest rates to encourage households or businesses to borrow more. And when we have a 19 basis point 2-year Treasury, we're telling Congress, don't worry about the deficit, just keep spending, just keep the red ink going, because debt doesn't cost anything. The price, interest rates are the price of money. They're giving a terrible signal to all parts of the economy to speculate and borrow, and it is not going to solve any of our problems. So I think what the Fed ought to do is basically retire from the scene and get out of the way and let this economy slowly heal itself, get interest rates back to some normal level.
Mike, I want to bring you into this. Do you agree with any of this?
I think, generally, I think what the Fed is engineering an enormous wealth transfer away from people with savings. And it's a global phenomenon. It's not just the Fed. People with money that they have designated for safety are not being paid a thing for it. And people who are borrowers, whether it's corporate, private households or government, are being basically aided at the expense of those people who've accumulated savings. I'm philosophically, I am not a believer in having central bank intervention in money markets or setting interest rates, period. I think we'd be much better off if the interbank rate was more volatile, and on a day-to-day basis, banks had to adjust their funding given what the market conditions were. That would be a much, much better way than guaranteeing that they always had access now at no cost to as much liquidity as they needed.
All right, let me ask you, starting with you, Michael, as an investor, purely looking at the underlying economic fundamentals, neither one of those things seems too far off as far as the realm of possibilities. Do we have another recession?
Well, I don't think so. Other than government, you don't really have an extended sector here that needs to be liquidated. Recessions are a process of liquidating excess, and the liquidation of the excess in government, both actual and conceptual, is going to take many, many, many years. I don't think it's going to be in an acute phase the way it is, say, in Greece or in Italy. That said, you have enough monetary tightness outside the United States, so we're going to feel the effects, I think, of some pretty sharp slowdowns in some of the emerging market countries, some of the big ones, and in Europe. So that's going to have a derivative effect on not only our economy, but on business prospects in some sectors.
David, if you were still within an administration, would you be advising your president or your economic team that, hey, get ready for another recession here?
I would say that we're at stall speed. We have been for 4 years. The GDP in the second quarter in real terms was lower than it was in the third quarter of 2007. And the reason we're at stall speed is that government is shrinking, business has no reason to invest aggressively, and the household sector is going to start shrinking, in my judgment, because all the gain in disposable income was indirectly compliments of Uncle Sam's backdoor borrowing. Let me give a number. $1 trillion gain in disposable income over the last 4 years, $600 billion from transfer payments that were borrowed, $200 billion of that from tax reductions that were borrowed. And now that the government has reached the edge, the credit card is done. It can't borrow anymore. There will be no more stimulus to disposable personal income. The consumer is going to get weaker, and the economy is going to continue to stall. And the budget deficit will be much worse as a result of that, because the baselines assume that we're having a normal recovery, 20 million jobs, and so forth, and it's not going to happen.
David, let me ask you about taxes, something we love to talk to you about. Warren Buffett also chiming in on that yesterday in his New York Times op-ed, saying, I would raise rates immediately on taxable income in excess of $1 million, including, of course, dividends and capital gains. And for those who make $10 million or more, and there were 8,274 in 2009, I would suggest an additional increase in rate. I'm assuming you agree with him.
Well, I hate to agree with Warren Buffett, but I think the idea that he was on, that we shouldn't be taxing capital gains at only 15% when you have the huge payroll tax and the income tax that the labor or the wage earner has to pay, was exactly right on. The capital gains rate was put in the 70s. I was there when we had double-digit inflation. There was a reason for it then. Today, it's obsolete. It's a windfall to the rich. It's a windfall to speculators and people with money to invest, and it is not right that we should be allowing, say, hedge fund managers to be taxed at 15% when the middle class is struggling and paying 30% of their income in payroll and income taxes.
You know, I'm curious where you are on this, Mike. I mean, there seems to be a gap between those who are either hedge fund managers and so on and so forth, and those investing versus those who are not in terms of what they're paying for taxes. Where are you on this?
Well, I think it's a technical question. The carried interest of people who get a proportion of the increase, whether it's a hedge fund or a real estate partnership or a private equity fund, that's something that can be discussed. But I'd say in general, raising marginal tax rates is not the way to increase the revenue to government. I don't have any objection to having more revenue come into the government, but raising the marginal rates, whether it's on income or capital gains, is not an effective way of doing it.
Carol, we're not getting the fireworks here that I want. Michael and David should be with boxing gloves in a ring. I mean, guys, don't hold back.
Okay, I won't. Look, I believe generally marginal rates shouldn't be raised, but we are so deep in the hole. We are generating so little revenue, 15% of GDP, and there's been such a massive gain to the rich, the top 1% over the last 30 years, that we have to look at the equity and the shared sacrifice and not just the narrow economics. And on that basis, I would say, don't raise rates across the board on working people, but get rid of the capital gains, and whatever rate you're going to have, make it the same for every kind of income that comes in.
Can I give you 10 seconds just quickly, Mike? Any thoughts?
Well, if you want more jobs, you need to encourage capital formation. I mean, that is the necessary precedent to job creation. And to the extent that you want that within the economy, raising capital gains tax rates is destructive.